Hi friends, welcome to Scientific Investing. So today morning I got a message from some of community members regarding share price of a company called NIIT Limited, and they asked why it's trading almost at 95 rupee price from 400 rupee. And given recently we have also been conducting the IT sector webinar where we have been tracking a lot of companies, discussing a lot of companies. This company has also been on radar. And these are typical special situation, demerger situation where these kind of activities happen. I have never done a video on this, so I thought, okay, let's explain how all of this happens through a detailed video. And please note that the demerger has already happened. So the idea is just to understand, how to look at these scenarios, how to value these companies, how to analyze such situations. Now coming to NIIT, this whole special situation, in my humble opinion, the special situation of NIIT started in 2020 itself. And this is one company I've been tracking from last 3-4 years. So let's first understand what is NIIT business is all about, and let's understand what has happened in NIIT since 2020. So please note that I'm a registered research analyst. I do have position in NIIT from the pre-demerger levels. I may buy or sell anytime. Please do your own due diligence and please take this video only for understanding purposes of how to analyze these special situations. So if we look at NIIT, NIIT is in the business of education, in the business of training. They train, they provide a lot of courses, lot of industry, certifications, and they train and they employ people and they get them placed. And they have two businesses. One is the B2B business, one is B2C business. In B2B business, basically they provide corporate trainings to existing corporate employees through corporate tie-ups, which means the money is being collected from the companies, whereas in B2C, basically they train the students who want to be job ready and they want to get placed. Sometimes they do special tie-ups. They do tie-ups with specific companies for specific mandate for hiring, where they manage the whole, selection, training, placement, all these things for certain companies. So these are the two businesses. And if we look into detailing of these businesses, the financials of these two businesses is very, very different. So CLG is the corporate learning business, which is the B2B business. And if we look at last 5 years of history, the CLG business has done very well on the revenue side, on the EBITDA side, on the growth side. A 3 to 5 year revenue CAGR has been around 21 to 25%, and the 3 to 5 year EBITDA CAGR has been 35 to 54%. And that this business works on a very good EBITDA margin, especially post 2020 with the scale up of the business, the EBITDA margin has increased and it's a 20% plus EBITDA margin business. The latest EBITDA margin has been 23%. And this is where they cater to. Basically, this business is focused across mature geographies like North America, Europe and all, where they manage the whole training services, L&D transformation activities and all of this for corporates. And SCG is the skills and career business, which is the B2C business. This business has been intensely competitive because of a lot of competition, and this business has so far not generated adequate profit. It is just doing break even to some loss. So low on the growth side, no profitability. That is the skills and career business. So these are the two businesses. Now, why I spoke about this special situation is not happening for the first time, but it did happen. It's happening somewhere since 2020. Is something interesting happened in 2020, just around the COVID time. And actually, this is the second time I have been invested in this company. During COVID also, I tried to play this special situation. So what happened, if you'll see the 2020 PNL, you will see almost a 1400 crore of other income for a company doing 900 crore of revenue. So the question is, how did it happen? And if you see in the market, you have two companies, NIIT Limited and NIIT Technologies. NIIT Technologies is basically IT company, and NIIT Limited, they did have a decent stake in NIIT Technologies and they decided to exit. And this was the 2020 time when the stock was trading around 96 to 100 rupee at a market capitalization of 1,400 crore, where they got almost 1,400 crore in the other income. And this was the time when they decided to sell, and there were PE funds who were buying this stake. And this is how you got this big cash coming into their books. The other interesting thing which happened in 2020 is NIIT decided to exit quite a few businesses. And I don't know how many of you know, I have a background from education sector. After my MBA, I worked in education sector for 2-3 years. And I realized, from outside, this sector looks very attractive, but there are a lot of challenges. And that is where after 2 years, I took a career change and I shifted from education sector. But I was aware of companies like NIIT, who is doing what, and I was aware of some of the challenges which are there. And when I read the annual report and when I saw NIIT exiting a lot of government businesses, a lot of school content businesses, this was something which excited me, because these businesses have been very, very poor quality business. And if a company is going to exit these kind of businesses, this is going to improve the profitability. This is going to improve the balance sheet. This is going to improve the cash flows. This is going to improve the return on capital and all the metrics. So basically, on one side, you have a lot of other income coming, where almost 70% of your market cap is what the cash is being held by the company. And then they have taken certain structural changes which could have a long lasting impact on the overall business. So this is how the 2020 special situation played out, where on a market cap of 1400, we had almost 1000 crore of cash on the books, plus some key business triggers, which was rewarded properly in terms of a special dividend, in terms of buyback. And actually the share price went up from 100 to 500 rupee. I did exit much earlier, somewhere around 300 rupee, but then the stock went to 500 plus, and then there was a 50% correction. Now last year NIIT and these discussions were going on, and the NIIT decided, because you saw the B2C business was not that profit making and B2B business was really doing well, and somewhere they felt that the market is not rewarding it properly. And these two businesses, though both are education focused businesses, their growth trajectory, their requirement, their nurturing, their customer base is very, very different. And then they thought to demerge and list these two businesses separately. And this is what the demerger which has happened today, what we see in the stock price, where the NIIT Limited share price is trading from 40 rupee to 88 rupee. But let us try to understand how it is happening and what are the contours of demerger. So basically the B2C business, which is SCG, that will remain listed as NIIT Limited, which is the currently listed company. However, now the financials of this business will change, because the CLG business will be taken out separately and be listed as a separate business. So basically the 1300 crore of P&L revenue which you see now in the currently listed entity NIIT Limited, this will become somewhere around 315 crore rupee, and this will represent this business. And the corporate business will get listed separately after some time, maybe after 7-8 weeks, based on the financials of the corporate business. So this is the whole detailing of the demerger, and this is why you see this share price falling. Now the market will recognize what is a true price for the NIIT Limited and what is a fair price for the corporate business as and when it lists. We will talk more about it, but before that, let us now try to understand these two businesses post demerger, how their P&L and how their balance sheet looks like. So first, the average business, which is the consumer B2C business, NIIT Limited, you can see not at all great growth. Don't worry, don't give a lot of importance to this 3-year CAGR, because in COVID everybody was sitting at home. The B2C training was impacted, and then when people came out of their homes, of course the training improved. So this is more impact of this. I will go by a 5-year, which is flat, which is high intense competition, still not able to break even. And this is the P&L. You have almost 340 crores of revenue and almost just doing a break even. But what is interesting is, because NIIT is because of corporate business, because of whatever happened in 2020, they still had more than 1000 crores of cash on the books on almost a 5000 crore market cap, which is almost 20% cash on the books. So that cash which was there, almost 1000 to 1300 crore of cash which was there on the book, That cash got redistributed between these two businesses, B2C business and B2B business. From that redistribution, we got almost 716 crore of cash on NIIT Limited, which you see right now trading at 96.97 rupee. So 350 crore top line, zero profit, 715 crore of cash. That is what NIIT Limited is. The more important business, which is the B2B business, which will get listed as NIIT Learning System Limited, NLSL, with a very good 20 to 25% growth history, still growing with good order book, with decent margin, with very good profitability. This business is doing almost 360 crore of revenue and 315 crore of EBITDA at 23% EBITDA margin and almost 200 crore of PAT, with almost 572 crore of cash on books. This is the one which is important, and this will get listed after maybe 1.5 to 2 months. Now, if we analyze how to now analyze this equation, what this 98 rupee represent, what will happen? Is it a fair price? So see, before the whole demerger happened, I mean, the today's price of the demerged NIIT Limited, the stock was trading around 400 rupee, which is almost 5,400 crore of market cap. And today, if we see the price of NIIT Limited, which is the B2C business, B2C price, it trades at 97 rupee. And as a part of demerger, so the NIIT pre-demerger, they had almost 13.5 crore share. And it has been decided by the management that everybody who holds one share of pre-demerger NIIT Limited, post-demerger, they will get one share of NIIT Limited and one share of NIIT Learning System Limited, which is B2B business. So if we look at 97 rupee multiplied by 13.5 crore share for the B2C business, today this business trades at 1300 crore valuation. So this is a business which is zero profit business doing 340 crores of turnover is getting a B2 valuation of 1300 crore. Please remember that they have 700 crore of cash on the book. So basically it's a 2 times sales, which you can say on basically if you remove 700 crore of cash, you have 600 crore of valuation for 340 crore of sale. But you can see the business has gone through a lot of pain in 4 or 5 years. So a lot will depend on, now I will not comment whether it is overvalued, whether it is undervalued. If I have to value as a conservative investor, the first risk I am taking is I am assuming that the 700 crore of cash will be utilized to make the business better, and that 700 crore will not be a sunk cost. And then if I can give a conservative estimate of one price to sales and I can value the business at 340 crore based on top line, because maybe they will try to revive it. If it doesn't get revived, it will get sold off, all that will happen. And we know what kind of things happened in EdTech. And actually the whole EdTech bubble is bursting. So that is another thing where the highly competitive intensive business where there was a lot of PE money flowing, some of these companies are going burst. So that is another thing. When you look at NIIT con calls, these things are getting discussed, and they are taking this as an opportunity to, go and kind of make the B2C business, more profitable. Nobody knows how all these things will play out, but let us see what happens. But as of now, they do have 700 crores of cash. And if we take a one price to sales, maybe 1,050 crore kind of valuation could be possible. But we never know how market reacts. I have seen there are times when companies' market cap goes below their, cash on the books, but that happens rarely. Lot will depend on the execution, that how now this separately, because now this is a separately listed company. They cannot feed themselves from the corporate business process a profit. They will have to survive and they will have to grow. So let's see what happens. But this is what is B2C business. Now, if you take this 1,300 crore valuation out of it, assuming this is how the market is valuing this business today. So from a 5,400 crore pre-demerger market cap minus 1,300 crore, we are left with 4,100 crore. Assuming, now valuation is a dynamic concept. Tomorrow market can bring this price from 97 to 80. It can take it up from 97 to 100. But assume if that is the price, basically market is giving this minus this 1,300, a 4,100 crore valuation to the corporate business. And we know the corporate business is growing at 20 to 25%. It is growing at almost 23% EBITDA margin. And it is generating almost 200 crore of profit. So basically, we are paying 20x for a 20% plus growing business at a 23% EBITDA margin and 570 crore of cash on the books. Now, again, it's up to everyone to decide whether it's overvalued valuation, it's undervalued. My sense is if they can keep growing at, and this year was a tough year because of whatever is going in the IT sector. And there was an impact on margin, which we could see. And actually, the last year to this year, profit has been flat, which is a kind of decent performance given the market condition. So now neither that high growth phase was permanent, nor this flat growth is permanent. The reality will lie somewhere in between. Now it's up to one to give what kind of growth somebody wants to build, whether he wants to build a 20%, 15%, 25%. But let us say if they grow at 15, 20%, which means they can double the profit. So in 3 to 4 years, this will become a 400 crore profit company. Again, if we value at 200 crore, it will become a 8,000 crore market cap company. But basically, I leave it up to you to decide whether it is the right valuation, undervaluation, overvaluation to you. But this is how, if we have to take a decision on demergers, this is how we need to separate the company. So the key message is, whenever you hear a news of demerger, we need to go through the details of demerger. What are the post demerger, share ratio? How much share one is going to get? What is the intent of demerger? So here you saw the intent. There was one company which was not doing well. You need to separate the books of account of these two companies. You need to separately value it. And then you need to see at what level market is valuing this whole company together and what level market will value. Because many times people think that special situation demerger means paisa banega. And many people have burned their hands recently with pyramid and all. So I hope this kind of exercise helps you to understand how to think about special situations and how to think about demergers. Now, I felt the 2021 was a pretty safe one because you had almost 70% of market cap lying in cash. The only thing we wanted to ensure is management doesn't do any kind of hanky-panky on utilizing that money and treating the minority shareholder. This looks like more fair to me. I think 20x PE for a second kind of company is a decent one, and my interest is more in that the B2B company. The B2C company, lot will depend on how they are going to execute. But in last 3 years, the management has given good signals in terms of monetizing its assets, in terms of exiting loss-making businesses, in terms of creating right structure for shareholding returns, and making respective businesses accountable for performance and to be self-sustainable. So this was all about NIIT special situation demerger. There was another activity which is happening in another company, which is not demerger but consolidating all the companies, which is Expelio Solution. We already covered it as a part of IT sector webinar. So actually we have covered more than 15-20 companies. If the whole businesses in detail, the ER&D business, software business, already 2 sessions have happened. We will do one last session soon. So if you are interested, you can go to our website, learn.scientificinvesting.in, and register for the IT sector webinar. Also, we run a practitioner membership where I think by now we have covered almost 80-90 companies, 10 plus sectors, market, charts, technical, fundamental, everything. So just explore the practitioner membership if this is something which interests you. I will see you soon with another video. And my last 2 videos have been more on the growth companies, where we try to go through the con calls, investor presentations, identified the 2 high growing companies, which were Menon Bearing and Talbros Automotive. Now my focus is, my idea of educating is educate different styles of investing by providing the right framework, providing the right analysis, and let everybody choose where they are good at and what excites them. So I thought, okay, in next 2 videos, I'll cover maybe some good value companies. So do let me know if you feel there is a good company at good valuation, or you want to cover some company from a value perspective. But please keep in mind, I like strong balance sheet. I like strong cash flows. I like good governance companies. So if you have any company which kind of clears this kind of checklist and going through a bad phase where you feel there is value, do let me know in the comment box and I will try to cover. But from my side, I have few companies in mind and I will see you with. So do like and subscribe and share this video with more and more folks so that we can reach out to more people. This is what keep us motivated. Thank you.